Question on that? Oops. Okay. Well, let's jump right into a fast, fun footwear. Just take a minute or two to read over it. It's not very long, and then we'll talk about some of the things about it that if you're thinking about taking the certified fraud examiner, the CFE exam, a lot of it comes to stuff like this. Just take a minute and read it, and then we'll go over it. It just hit me that these answers, I should probably make salesperson A answer A. I'll leave it for now. It doesn't matter. In the future, I'll switch that around. A little bit confusing. Okay, so you walk into this situation. Who would most likely is the most likely suspect for the missing shoes? Customers, salesperson A, or salesperson B? Anyone want to throw out a guess? An educated guess, but a guess. And again, this is you don't know exactly who did it from this information, but which is more likely? Oh, I know. We can do it in a poll. A one-question poll. You're gonna do. You have to answer 9, ridiculous ones. 9. You have to answer 2 through 9. But so whatever it is, and I will not look at your name. I won't look at anyone's. Just curious. So which one do you think is going to be the customer A, salesperson A, or salesperson B?
Is that the entire story, just the first one? Salesperson B, is that the whole thing? Oh,
Yeah, oh, I sent these out. You guys don't have it? It's in the it's in Blackboard. It's also sent to your email, but I can.
okay, let me check it.
The whole thing. Be small. Oh, come on, only one person.
I mean, if I were the manager, I'd just check the cameras because I mean, I don't want to like.
We'll assume that they didn't have cameras.
Yeah.
I guess nowadays that would be, it might be a little bit dated.
I would say it's person B. He can cover up by saying that he already has a pair. I don't know, maybe it's the same pair.
So let's see what we got. We got 3 people answered so far in the poll. I don't know if people are attending. That's what I should look at.
Can you scroll down, please? Okay, thank you.
I think it's salesperson A, honestly, just because of his response, being angry and all.
Yep. Yeah. Yeah. So did you guys put it in the poll? What did I do with the poll? I lost my poll.
Oh, I think I chose the wrong answer by mistake. But
Well,
yeah,
well, and quite honestly, here, guys, there is no right or wrong answer. We don't know from this who exactly did it. It could be any one of these. The question is, who would be most likely? You know, there really isn't a right or wrong on this.
I would just guess A then because he has less evidence to back himself up, I guess. Or salesperson A.
Okay, I think, do we have everyone? I think we have everyone. Is that right? Is there 5? Is there 5 in here? Or are there 6? 1, 2, 3. We're missing one person. Okay, one person who's missing. We'll go ahead and I'll go ahead and post this.
It's me. I'm just trying to answer it, but
Okay, well,
I'll click on the submit. It's not. Do I have to answer all the others?
I think you do. I think you can put anything you want in for those because it's
Oh.
not gonna matter. You know what I mean? It's not gonna make any difference.
Professor, I'm not sure whether I'm able to submit or not. Like, can you see my answer?
I can't see it right now because I haven't closed the poll yet, but it looks like I got everybody. So I think there's 6 people in the class right now. There's 6
It's
answers.
just the question number 1, right? We have to answer right now.
Yeah, just wait. Yeah, exactly. Okay, share the results. Generally speaking, people look at, again, we don't know exactly who did this, obviously, but the most likely is B, salesperson B, I should say. And we'll go through kind of why. Customers, it would be hard for a customer most likely to steal an entire box of shoes. Not that it's impossible, again, we don't know who did it, but it'd probably be more unlikely. Customers more likely are going to pick up something that's on the floor. Not only that, employees are 6 times more likely to steal from a business than a customer. There's 6 times more theft from employees than from customers. And why? Opportunity. Opportunity and familiarity and all that kind of stuff. So customers are while it is possible, shoplifting does happen. These are usually less likely than employees, and especially for something that's like a large box of shoes. Okay, so let's go to, let's learn how to use a. Okay, so salesperson A. Reacts with anger. Anger is the normal response when somebody is accused of doing something they didn't do. It usually is that. Now, does that mean that salesperson A is no? It could be salesperson A. But when someone's accused of something they didn't do, their first reaction is anger. Well, you gotta be kidding me! What? No, it's that's usually what it is. The first reaction. There are some things that are, if you go to the salesperson B, what from salesperson B's answers would raise questions? So like, did you take the shoes? I couldn't have taken the shoes.
He's blaming the customers, and he also is trying to cover up by saying, maybe I already stole them, but I already have a pair of those. So I don't know.
Yeah, there's this down here that first of all, they like the shoes. If they have their, there is that, Adam. But this last sentence here is the one that's actually more interesting. One of the things that first of all, a lot of times fraud or theft is not rational. They find people all the time, people steal stuff and throw it in their closet at home, and it's not rational. But a lot of times, one of their defenses is they try to make you explain their irrational act, and they'll have something in their hand even and say, well, why would I steal this? And even though it's right in their hand, why would I steal this? And that is one of those things that they try to put it on whoever's questioning them to explain their act. So that's one of the highlights that came from just that second sentence. But what about this one? What's unusual about this up here? I want to break it up into 2 parts, actually. I couldn't have taken the shoes. I was in the store they were the customers. Look at my register tapes. My sales were all from the front of the store. What's unusual about that? that whole little paragraph. Most people don't, when confronted, don't just bark out an alibi. Not only that, they're not knowing, they didn't know whether the shoes were put on the floor or not. Being in the front of the store may have nothing to do with it. You know, so whenever someone has a ready-made alibi, you ask them about it, something, go, oh, well, I was, you know, whatever it is. That's not usually people act. You know, what were you doing? I don't know. Customers, I guess. I don't know. But let me think. You know, I mean, that's usually if somebody asks you what you were doing. That's what, but so whenever someone has an alibi, a quick alibi, it's suspicious because they've thought about it. This second part down here that I broke apart is also an interesting one. And that is another thing that they try to do, people who commit fraud, is try to give you a diversion, a plausible somebody else to look at, or some, you know, some other thing that could have happened. And the reason why it's one of the things that's very telling about it is these are usually not definite. They usually have things like words like probably. Why? Because they want to be able to back out of it at some point. They don't use definite terms. Well, it's probably a customer, or, you know, maybe somebody did, you know, so he maybe, probably, those sorts of things. They start, you know, first of all, they, you know, the alibi, you know, it's ready made, and then they also have this to keep you, you know, well, here, you know, it's probably a customer. Maybe it could have been a security guard, or, you know, they will start offering other plausible things besides what they're, and usually without any evidence of it. You know, it isn't like, now it could be that, oh, well, you know, I found the box over here. Without that, the story, you know, there's someone took, you know, that's a little bit more definite. But if they use words like probably, maybe, those sorts of things, it also is an indication. A lot of times those words are used specifically so they can back out of it if they say something wrong. I didn't say that. I said probably. I didn't say it was. Whatever. So anyway, again, there is no right or wrong answer to any of these. It could be any of them. Could be all of them. It could be collusion. They all got together and decided to steal a bunch of shoes. But generally speaking, the salesperson fee is probably the one that you're going to most likely focus on in something like this. And again, anger is when, if you're confronted about something you didn't do, anger is usually the first thing that comes out. You know, it's you know, anger or someone being upset is very common. But so, you know, look for people that have, you know, alibis built in, especially, and using vague words, probably, maybe, could have, maybe they did this, you know, that sort of thing. Those are all vague terms, and those are purposely vague because they're something you can't really pin down on them. And then this one is a very common one, though. Why would I take them? I couldn't have done this. Why would I do this? That's what I mean. All right. Next page is some of the strange things about fraudsters, which is, fraudsters is the coolest name ever. If it wasn't such a bad thing, I would probably call myself a fraudster. But the characteristics of fraudsters are way different than most people in, say, the criminal population. And so, you know, as you do fraud investigations, you're not looking for your typical somebody that way, you know, for instance, someone who's a violent criminal or something like that. They're way different. They're very different from most people in for instance, in prison. The prison population is very different for fraud, for people who commit fraud, than other people. Okay, so let's go to the following characteristics. What do you think? Highly respected. Would that be a characteristic of a fraudster?
Yep.
Yeah.
They usually are. Committed a violent crime in the past?
Yep.
Actually, no. People, if someone's committed a violent crime, they usually don't commit fraud, or vice versa. Again, it's kind of a strange thing. It isn't just, all crime. Now, could there be? Yeah, I mean, but generally speaking, committed fraud in the past.
Yes.
Yes, recidivism for fraud is very big. You get people that will get locked up and you think, okay, they learned their lesson. They don't learn their lesson. Highly religious.
Maybe not.
Yes.
You would think no, but it's yes. And by the way, it's one of those things, well, why would I do that? I'm a youth pastor or whatever, It's one of those strange things. Now, it doesn't go the other way. It doesn't mean that all people who are highly religious commit fraud, but there is that characteristic that a lot of people that commit fraud are highly, religious. They'll go to, mosque or synagogue or church, 3 times a week or whatever, and there you go. So young people.
No.
Nope.
Necessarily.
Middle-aged people.
Yeah.
Not necessarily.
Not necessarily. No, none of these are 100%, but middle-aged people are more likely to commit fraud. Is one of those crimes that it's not usually it's not usually a crime of youth. Fraud is. New employees.
No.
Nope, not usually. Unless this has happened, unless they committed fraud in the past, then the new guy is maybe the one to look at. Old employees.
Yes.
Yep.
Yep. Friendly.
Yes.
Yep. Extroverts.
Maybe.
Yes.
A lot of times, yeah. Punctual. They show up on time.
Yes.
Yes.
In fact, they don't miss a day. College educated.
Yes.
So looking at this is not your normal characteristics of someone you think is in crime. This looks sort of like me. I mean, if you were looking for fraud at Roosevelt, it's that guy. And that's one of the hard things about fraud is about finding it, is that a lot of times they are the friendly, people who get their job done. They're educated, all those things that you'd normally wouldn't associate with someone who lives a life of crime. Those are all things that a lot of times are indicative of somebody who is in fraud. So, looking at this, this is why it's hard sometimes to find out who is, it's not like in the movies where you get somebody in, oh, I'm going to steal this. It's not like that. The nicest, friendliest, most punctual, helpful person in the place is more likely than others. And not only that, a lot of times, talk about being this friendly person. And you kind of, if you guys remember that, my brother-in-law, that probably, usually a lot of times there are people that are trying to please. Fastow, the guy from Enron, the accountant, the controller from there that did all these, he kept saying, they just interview with him, and he's in federal prison for like 9 years or something. And I'm not the bad guy, I'm the good guy. Everyone wants profits, I made profits. Everyone wants profits. Wall Street wants profit. Stockholders want profits. The employees want profits. Everyone wants profits. I gave them profits. All I did was give everybody what they wanted. He was just trying to please everyone. That was his angle on it. Now, he did all these crazy things. Like, yeah, I know I did that, but this for profits. I did it, because everyone wants profit. That's what I did. So sometimes you get these people that are overly trying to ingratiate themselves or whatever with upper management or just people in the company, and look like a big hero. that kind of thing. So, sometimes this is, while I wouldn't encourage them to be not friendly, sometimes there is that thing that, people are too friendly, that they're too willing to do anything to get, to make themselves or the company look good or whatever. So anyway, that's just a little thing. But if you take the CFE exam, they go into a lot of stuff like this. The people that, what to look for, people that have alibis, people that use vague terms, people that, a natural reaction to being accused is anger. You get mad about it. None of those are necessarily definitive evidence, but they are indications. Okay. Well, chapter 19 here. I think I'm gonna do the chapter. What time is it? We'll do a little bit of this one, then we'll take a break and then we'll switch over to the sampling practice exam. Okay. So let's go to chapter 19. I call it ethics. We call it integrity, objectivity, and independence. Same idea. So anyway, the first part we're going to cover is what they call covered members. And the way that came about is that they say, okay, there's certain people in a CPA firm who are the idea that the onus to be independent is more heavily on them, and it's usually because of their client. So if I'm out auditing IBM, okay, I have more responsibility to be independent than, say, somebody in the company who's not auditing IBM. Someone who has nothing to do with the audit, they have a less of a requirement that they be independent. So there are some people in the company who are more required to be for this independence than other people, and they called covered members because these rules cover those people that are in it. And so there really are it's sort of like this. There's two sets of rules. There's rules for covered members, and then there's much more lenient rules for non-covered members. So covered members are the people that really have to stick by the rules. They have a lot of rules for independence. And then there are non-covered members. They still have rules, but they're nowhere near as restrictive as those for covered members. So the whole idea here is that the covered members have a higher standard that they have to live up to when it comes to independence. Now, CPA firms can be organized however they want, but for these rules, they're required to fit all the employees into one of these four categories that you'll see here. So they can be, they can be organized however they want, but they must be organized into this. So you have partners, managers, seniors, and associates. Now you say, wait, our firm doesn't have those. Well, for you to be independent for the CPA, if you're for auditing, you have to fit the people in here somewhere. So if you say, well, we don't have partners, well, find out who would be a partner if you did have partners and put them in there. We don't have managers. Well, find out who would be a manager and stick them in there. So CPA firms are required to put people into these kind of categories, these four categories: partner, manager, senior, and associate. Generally, these people are all CPAs. Everything above associate is going to be a CPA. Associates are people that are new to it. Okay, so the question is, well, who has to be more independent than other people? All right, the first group is anyone who's on the audit engagement team. I'll make these red, I guess. So these people are all required. If you're on the audit of IBM, we're going to hold you up to higher standards than other people. So anyone on the audit engagement team, anyone who's on the audit, say of IBM, will have to be at a higher standard of independence than anybody else.
Why just the partners, the partner 3, manager 3, senior 3, and associate 3? What of the others?
Well, of the others, the partners are going to be there. Here's the thinking behind all of it. Anyone who could influence the audit is a covered member. So anyone who could influence the audit is a covered member. So anyone who's working on the audit could obviously influence the audit. Anyone who's a partner in the office itself has the possibility that they could influence the audit, and they could do it from a number of different ways. They could influence it. They could be having their people work on the audit. It could be that they review the audit. A lot of times one partner will review the audit of another partner. So there are ways that other partners in the firm could influence an audit. And here's why they want to be so careful with this stuff. The only thing that we lend to financial statements are credibility. And if the credibility, isn't there, if they say, well, there were some people on the audit firm that owned a bunch of IBM stock, you just defeated the entire point of the audit. At that point, the audit's worthless. Doesn't do anyone any good. Banks can't rely on it. Investors can't rely on it. No one can rely on it. So the point is that anyone who can influence the audit is going to be a covered member. Usually, they're going to be held to a higher standard. And the new person over here, who has nothing to do with the IBM audit, it probably doesn't really matter what they do. Someone who's working on the audit, definitely. They could definitely influence the audit. But this person over here has nothing to do with the audit. Just got there. Maybe just got there today. They have nothing to do with it. So this is the audit engagement. And by the way, in the engagement office, if you get a job, in public accounting, they usually pass around a list of their clients. And they say, do you own stock in any of these? If you say yes, oh, well, you get to sell that stock because they just don't want to deal with it. So usually there'll be a list that they'll say, if you own any of this stuff, you got to get rid of it. But okay, now there are people who are in the consulting world. They call these non-attest services. And they could also influence the audit. And the two people that they look at are the partner and the manager. Notice for consulting, the senior and the associate are not included. So it's a little bit different than the audit. People who are doing the audit, anyone on the audit, top to bottom, anyone on the audit is a covered member and must be held to a higher level. For consulting, only the partner and the manager can be held to a higher level. Senior and the associate are not. There's another quirk here. The 10-hour rule. The 10-hour rule is that only those people that do consulting who bill more than 10 hours to the client are considered covered members. So if you only do 4 hours worth of work for them, you're not considered a covered member. If you do 14 hours, you are. You did 10 hours or more of work for them. So that these will often be referred to as the 10-hour people. The 10-hour people are consulting people that are either partners or managers. and they've done more than 10 hours worth of work. If they haven't done 10 hours worth of work, they're not a covered member. And the idea is, maybe this is a tax manager or something. It could be that the client had some tax issue and they fixed it and they billed them out for 3 hours of work or whatever. That person is not really so involved with the client that they're going to have influence over the audit. That's the thinking anyways. So the 10-hour rule is really there to avoid someone being a trivial amount of time spent with the client, doesn't land you into this covered member thing. So if in the last year, more than 10 billable hours, then you're a covered member if you're partner or manager. And if you're not, if you don't do 10 hours, you don't have to be a covered member. You're not a covered member. And seniors and associates are not covered members. So a little bit different. And so these are the three main ones. These are the ones that are usually they're a little bit more heavily tested on the CPA exam, and in real life, they're the ones that are the ones that really have to be paying attention to make sure that they are independent. Okay, B is kind of a catch-all, and that is anyone who's in a position to influence the audit. Senior partner. You may have a senior partner that oversees several offices. If they can influence the audit, then they are a covered member. They must adhere to these higher standards. Kind of a wacky one. The CPA firm itself is a covered member. The entire CPA firm is as if it's an entity, as if it's a person, it's a covered member. The entire CPA firm has to adhere to higher rules. For example, the thing here is the employee benefit plan. Maybe they have a pension plan. And if they're auditing IBM, that pension plan cannot have IBM stock in it. So, the CPA firm itself is a covered member. This last one is kind of a catch-all, and that's to kind of keep somebody from trying to get away from, these rules up here usually. And that's any entity that's controlled by covered members. So if you have an entity that has more than 50% ownership is covered members, that entity is a covered member. And it doesn't matter what the individual has. Maybe an individual, maybe you have 3 partners and each partner only owns 1/3 of this entity. And so any partner could say, well, I only own 1/3 of it. I don't control it. If the total control is by percentage is the of covered members is more than 50%, it's a covered member, regardless of whether one person has control of it or not. So, if an entity is controlled by covered members, it's a covered member too. If it's not controlled by covered members, so let's say that I own 20% of this business in it, and I'm a covered member. If I'm the only one that owns 20% of that business, that business is not a covered member. So, this one is any entity that's controlled by covered members is a covered member. Okay, now here's the fun part. The rules. Direct financial interest. So this is directly buying shares of stock or bonds. But if you have an interest in the client is prohibited, regardless of amount. So if you're auditing IBM, you cannot own 1 share of IBM stock. You cannot own one IBM bond. See, wait a minute, bonds are, you can't own it. You can't have an interest in the client. So any of their securities, you can't have. Okay, indirect are a little more complex. Oops, so complex that I just goofed this up. Okay. Indirect interests are allowed if they are immaterial. And I'm going to give you some examples. Standard & Poor's. I don't know. I don't know. I'll look it up later. Standard & Poor's 500 fund, where you have 500 of the largest companies. You buy stock in 500 of the largest companies. Usually it's a weighted by their market cap. So, okay, we got the Standard & Poor's 500 fund. Now, notice that as an investor, you're going to buy into the fund. The fund will then buy the stock. So it's indirect. So you're buying the stock of, you're buying the into the investment fund, whatever the shares are in there. And that fund is then buying stock. Now, IBM, big company, I assume is it'd have to be in the top 500 largest companies, but it's one of 500 companies. So if you have a Standard & Poor's 500 fund and IBM is in it, it's going to be immaterial because there's no way one company is going to move that very much one way or another. There's 499 other companies in it. So this would be an indirect one. Could also be investment in a bank. And the bank loans money to the client. So, okay, so I have an investment in Bank One. And Bank One loans money to the client, to IBM or whatever. Then notice I'm not loaning the money to IBM, but indirectly I own this bank, and the bank is loaning money to. I just hit my mic. I'm sorry if that came out as loud. I guess I waved my hands around from my pockets. So the investment in a bank would be an indirect one. And as long as the bank loan wasn't so much that it was significantly material to the bank, it wouldn't be a problem. So Bank One loans some money to IBM. Generally, it's not going to be a problem. Indirect. Any questions on that? So indirect interests are allowed as long as they are not material. If they are material, so let's say there's a tech fund, and this tech fund, 40% of this tech fund is IBM stock. Okay, now you're getting to where IBM, if it goes up or down, is really going to have an impact on that, that tech fund, because it's 40% of the stock is in, so that's probably material. Almost have to be material. So it isn't that all mutual funds are off the hook, but generally speaking, if they're not material, they're okay. Okay, so let's do some cases here. Gina is a member of the audit engagement for IBM. Okay, is Gina a covered member?
Yes, she is.
Yes.
Yep, she's on the audit team. She is a covered member. She owns 5% shares of IBM stock. This ownership is immaterial to Gina. Okay, does she have direct interest or indirect?
Direct.
Direct. And they say it's immaterial, but materiality does not matter. Is she in violation of the rules? Yes. She's in violation of the rules. You cannot have any direct interest. So if you're a covered member, direct interests are a no-no.
Why is it immaterial?
They said it
The
is.
amount.
Yeah.
Oh. Okay.
Yeah. So if maybe who knows? Gina, maybe she has a bunch of different stock in bunch of different companies, but the 5 shares in IBM, even though they're not material, you can't have it. You cannot have an interest in a client and do the audit, be on the audit engagement team. Okay, Greg is a member of the audit engagement team. He has I just talked about this one. He has an investment in the Standard & Poor's. Let's see something. Oh, I just called it S&P. That's what I should have done. I didn't have to spell it out. S&P 500 mutual fund. Because IBM is in the S&P 500, he has the mutual fund has a direct interest. Okay, now the mutual fund does have a direct interest. Does Greg have a direct interest?
No.
No. Greg invests in the mutual fund. The mutual fund does have a mutual fund goes out and buys the stock. Okay, so Greg's on the audit engagement team. So is he a covered member?
Yep.
Yep. Direct interest?
Indirect.
Nope.
Nope. Indirect. Good. Material or immaterial?
Immaterial.
Immaterial. Yeah, one of 500 companies. Is he in violation?
No.
Nope. Indirect, immaterial, he's fine. Helen is not a member of the engagement team, audit engagement for IBM. However, she's a senior auditor in the office, in the engagement office. She owns 500 shares of IBM stock. This investment is material to Helen. Okay, is Helen a covered member?
Yeah, she's a senior.
Nope. She's actually not.
Okay.
She's not on the audit. So, Helen's one of these
Oh.
over here. Yeah.
Got it.
So, if she was a partner, then yeah, it would be a problem. But she's a senior. She's not on the audit engagement team, so she is not a covered member. Direct or indirect?
Indirect.
Actually, it's direct. She owns 500 shares of IBM stock, so she has direct interest. And material or not material?
Immaterial.
Material.
Material.
Well,
Is she in violation of the independence rules?
No.
nope.
Nope. Not a covered member. So that's an important thing to remember, that you know, the strict rules, these rules only apply to covered members. If they're not covered members, doesn't apply to them. There are some other rules that will come out later, but for the most part, though, you know, the real strict independence rules are for only the people that are covered members. If they're not covered members, rules don't apply to them. Okay. We'll do this. We'll do this page, and we'll take a break. How about? Then we'll go to the statistics stuff. Okay. Well, one of the ways you know you can imagine people would try to get around this and say, okay, I have you know, I have 500 shares of IBM stock. I'm a covered member. I can't have this, so I'll give this to, you know, my wife or my husband or my kid. You know, the idea that you would have somebody, you know, in your immediate family, basically, that you would give the stock to, and then it wouldn't be you. Well, immediate family members are considered covered members. They're the same as the covered member themselves. So being a covered member, anyone in your basically your house, and when I say that, basically when you go home, who's ever there, that's your immediate family. So this is, let me put this. So your immediate family members are going to be spouses, spousal equivalents. How do you spell equivalents? So anyone who acts is, you know, basically appears to be your spouse. It could be, you know, be a gay marriage. It could be you know, whatever, a civil contract. It could be a live-in boyfriend, girlfriend. Could also be in there. Dependent children. Those are your immediate family members. They are considered to be the same as a covered member themselves. So these will be, because, you know, whoever is a covered member, anyone in this group, basically anyone you see when you go home, you know, is going to be, you know, they're going to be the same as the covered member themselves. Okay, so Sharon is a member of the audit engagement for IBM. Sharon does not own any stock in IBM, but her husband owns 10,000 shares of IBM stock. Okay, so Sharon, is she a covered member?
Yes.
Yep. The interest, is it direct or indirect?
Direct.
Direct. Is it material?
Yep.
Probably. That's a lot of stock, but it really doesn't say. Even if it was immaterial, it wouldn't really matter. Why?
Covered member.
Covered member, direct interest. No, it doesn't really matter whether that's material or not. Maybe they're super wealthy and it's not material, but it doesn't matter because you own one share of stock. Is the share in violation of independent rules? Yes. Okay, let's go down to Steve. Steve's a member of the audit engagement for IBM. He's not only shares of stock, but his daughter owns an immaterial amount of IBM stock. Okay, Steve. Covered member or not covered?
Covered.
Covered member, part of the audit team, so he's gonna be a covered member. Interest, direct or indirect?
Direct.
Yep. And it's immaterial. Okay, so is Steve in violation?
Yes.
Yep. Now, there is a, truthfully, this is a little bit vague. One of the things that you would have to look into this a little bit further about is this. Now, I would assume that this is a dependent daughter. But if it's not a dependent daughter, or somebody who's independent, someone who's moved out, it's a different set of rules. So this dependence, whether they're dependent or not, actually is a big factor. If it's a dependent child, which is what I'm assuming this is here, it's a no-no. But I mean, notice that if it was an independent daughter, the daughter might live 5,000 miles away and never talk to dad. So, or yeah, there is a little bit of vagueness here, but just speaking, if their daughter, if it's a dependent child, that it is season violation. Okay, Joan, remember the audit engagement for IBM. She has, oh, this is what I was talking about. She doesn't not own any stock, but her husband has a large investment in technology, in a technology fund. 40% of the technology fund's holdings are in IBM. Like a broken record, that's what I just said. Okay, Joan, covered member? Yep, on the engagement team. Interest, direct or indirect?
Direct.
Actually, it's indirect. It's a technology fund, so it's going to be indirect. My underline. It's going to be indirect. Material or not material? Will IBM, the fortunes of IBM, have a big impact on this technology fund? Will they have a material impact or immaterial impact, do you think? 40% of the fund is in IBM stock.
Immaterial?
It would actually probably be material. If 40% of your investment is in the client for this fund, whatever that client does is probably going to have an impact on the fund itself. 40% is a lot. Notice the difference between this one, 40% versus the Standard & Poor's 500, where it's 1 in 500, which is, probably at best maybe 1% of it or whatever the total value. So, yeah, it's indirect interest, but it's material. Are they in violation? Yes. Only if it's immaterial. So, there is a question of, okay, well, so what percentage, right? I mean, if less than 1% is clearly okay and 40% is clearly not okay, is where do you draw the line? And that's something that's somewhat vague. I mean, there is no, you don't have any rules on percentages like that. But yeah, so it's going to be a judgment call as to what actually, of when it becomes, what percentage of the fund does it become a material versus immaterial. judgment call. Okay, we will stop there. And, let's say, be back. Oops. Actually, I'm going to do a little different. Stop here. And the next thing we're going to cover is the sampling this thing. So let's say be back at, I don't know, when do you guys want to be back at? 7:10? Is that enough? Okay, we'll go ahead and take a
Really
break.
good.
7:10's okay? All right. So we'll come back and we'll go over the practice exam. Okay. Practice exam. Okay, so the auditor allows for an error rate of 6%, and the allowance for sampling risk. Now, this is sort of like the standard deviation is 3%. So my focus, Dougie. All right. So, you know, if you take this as being switch cameras here. No, I don't want to switch cameras. You got to switch me. Give me a second here. Okay. So for this one, you know, here's 100%. And they say that they'll allow for 6% to be, you know, this be off by 6%. So this is what kind of, okay. So they're saying that they'll take, you know, if there's 6% of these are wrong, they'll take them. So we're going to do a sample now. Remember, this is a sample. So the allowance for sampling risk is 3%. Okay, so sample 300 purchase orders, orders with management signatures and orders without. So what's the error rate for this one? We took 300 purchase orders, 285.
5%.
Yeah, so 300. So 15 errors, 300 orders. .05 or percent. Okay, so 5% is what that's our best estimate of what it is. So going back to this thing, so this is our best estimate is 5% error rate. So this is the our allowable. So allowable rate is 6%. This is our actual rate that we find. But now notice that we have the allowance for sampling risk. This is sort of like our standard deviation. We would allow for 3% either way. Now, the one that we're going to be looking at is 3% going this way. So this thing could be off by a total of 8%. I don't know why I did that, but you know, the 3 plus the 5 is 8%. So this is our best estimate is what it's off by, is 5%. But because this is a sample, the other 3% for that allowance for risk means that this could be off by as much as 8%. So can the auditor rely on the controls over the purchase orders? Yes or no?
Yes.
No. Why? Because the actual 5% plus the allowance for sampling risk and when we say sampling risk, we're saying that because it's a sample, you know, that we're not taking 100%. So the total there that it could be off by, the upper limit is 8%. So we're going to compare this 8%. Compare that to the allowable amount of 6%, or tolerable, I guess, probably a better way to put it. So we're saying that they're saying that if they was 6%, they could live with it, but we're at 8%. So no, cannot rely on it. What is the misstatement of the purchases? That's right. We don't know. This is testing for controls. And we're just looking at department signatures. So the one thing about testing for controls is you don't know the dollar amount. It might not be misstated at all. Yeah, just because the controls are bad doesn't necessarily mean that the financial statements are incorrect. So, you know, whenever you see this test of controls, you're not looking for dollar amounts. You want to know if you can rely on the controls. If you can't rely on the controls, you can do something else to find out whether they're misstated, they're totally misstated. But just because the controls aren't working does not necessarily mean that there even is a misstatement. Not, you know, you have to do testing of the dollar amounts. How would the result of the impact of the plan substantive test of 500, hold on a second, I can't read this, of 500 items? Okay, so we had planned, you know, if this was at 6%, you know, if we could rely on the controls, we would plan on taking a test of 500 items for the dollar amounts. So some of the tests are for dollar amounts. So if you rely on the controls, we would take 500. If we can't rely on the controls, we have to take more or less than 500. What do you think? So we cannot rely on the controls. If we could rely on the controls, we would have taken 500 items. So will we need to take more items or fewer to get just as comfortable?
Or
More. I'm just making this number up. Yeah, so if you can't rely on the controls, you're gonna have to bump up the amount of testing that you're gonna have to do for dollar amounts. Because you can't rely on these controls. So maybe instead of 500 items, you go to 700. I just made that up. But you're gonna have to you're gonna increase it because you can't rely on these controls. So it's gonna take more of this other type of testing to get just as comfortable. And there's one reason why you want to rely on the controls, by the way. One of the reasons why you do the test of controls is so that you can have a more efficient audit, is to avoid doing excessive, say, sampling of down here in the for the dollar amounts when you don't need to. But however, if you can't rely on the controls, you know, then it's to plan B, which is just taking a bunch of items. Is this test required by the ACCPA? No. Test controls is optional for the ACCPA. Yeah, I might as well. Any other questions here? I might as well round this out. Yes, for the PCAOB. You actually give an audit of internal controls. You have to do an audit on the internal controls for publicly traded companies. So it's optional for the AICPA. You only use them if you want to, and if you want to try to reduce make your audit more efficient, you can use them. PCAOB, you're required to test the controls. Why? Because you're actually going to write an opinion on the internal controls. So you have to test them to know whether those internal controls are working properly or not. So AICPA, not required. You might still want to do it to reduce the cost of the audit. If you can, I mean, obviously. PCAOB, there's no way around it. You got to test them because you're going to write a report on whether these controls are working or not. So, not to extrapolate this too much further, but notice that the AICPA, you know, the audit report is on the financial statements, not on the controls. So because of that, you don't have to do, you know, they can get a clean audit even if they have bad controls. Whereas down here, the PCAOB, if they have bad controls, when they do the audit of internal controls, they're going to get a bad audit report. Even if their financial statements are fine. You know, they could get dinged on the audit report. Okay. So the rest of these are all substantive testing per dollars. I guess I don't need that. But anyway, so these are the rest of these things we're going to go through. These are all substantive testing. This is for dollar amounts. You know, we're trying to figure out how much the dollars are off. We don't know what the controls are here, but we do know that you know, that we're gonna try to see what these are off by. Okay. What's the average audit? So here's our sample. Oops. Hey. Put it over a little bit. You guys can probably do this in your head. What's the average audit value of the sample?
Is it 50?
Yep.
5? Oh, okay.
Yeah, you get it right. Yeah. So this is just divide this by 1,000.
Yeah.
And same thing here. I think I told you guys this. If I did, I should have. When I took the CPA exam back in the day, like 100 years ago, we weren't allowed to use calculators. So a lot of times on the test, you would have stuff like this, you know, they're just nice, easy numbers because they couldn't use calculators. And it was kind of neat too, because, you know, in some ways it was easier because if you came up with 4.6237, you knew you did something wrong because there's no way they're going to give you a number like that. You know, so if you came up with some wacky number, you go, okay, I did something wrong. You go back, oh, here it is, it's 50. Okay. So mean per unit. What are we going to do for the mean per unit? Well, first of all, mean just means average. Whose average are we going to take? Our average or the client's average?
The auditors are.
Yeah, exactly. Got it. What we did, we'll say, okay, we're going to take what we did and say, okay, we think that everything is worth $50 each. So take the total number of accounts receivable. Yeah. Uh, 8,000. And what we're going to do is say each one of those is worth $50. And so this will be our project. What am I doing here? It's 8,000 times 50. That 400,000? Yeah. So this would be $400,000. This would be the projected value. Okay. What is a projected misstatement? Well, they're saying that their books are worth $380,000. So the projected misstatement is Is that an overstatement or an understatement? 20,000?
Understatement.
Yep. Very good. Okay. Yeah, so this is a did not do very good on the formatting on this thing. So they're saying it's only 380. We're saying it's 400. So this is understated. All right, ratio means that everything is off by a ratio. And basically what we're going to do is take the audit average divided by the book average, and then multiply that by the accounts receivable book value, the total 380,000. So we're saying, okay, we're saying, and by the way, this ratio estimation is probably the most theoretically sound of them. What it says is, look, things are going to be, it's more likely that big things have big errors and small things have small errors. An $80 account is probably not going to have a $6,000 error in it. Right? A $400,000 account could have a $6,000 error in it. Now, you know, so you know the size of it means that, you know, the size of errors are proportional to the size of the item. So that's kind of the ratio estimation. For most accounts, this is probably the most theoretically. So we're going to take the audit average. It's $50, I think. Divided by the book average. 48. And we're going to multiply it by the accounts receivable I say total book. And so this will equal our projected misstatement. Okay, so 50 divided by 48. $1.004 or something. Times times 3, oops. If you round it, it might be a little bit different than mine. I got 395,833. Change that a little bit.
Yeah, that's right.
Yeah, put an extra 3 in there. Okay, so yeah, so this will be our projected value. Again, if it could be a little bit different if you did different rounding. Oh, wait a minute. This is wrong. I should put 2 8s in. Hold on. 395,833.3. Okay, I think that's it. So this is my projected value. So the projected misstatement would be um, $15,000. Oops, let's put a comma there. And that would be again a understatement, right? We're saying it should be 395. They're saying it's 380. So that's an understatement. What's on that thing? Okay, again, these are for the dollar amount. So this is, we don't care about the controls. We're just looking at the dollar amounts for these. Man, I use a lot of space there, didn't I? Okay, let's see. Difference estimation. Take the difference. Subtract. This was a little bit unusual, so we get a difference here, which is $2. And what we're going to do is say, okay, every item is misstated by $2. I'm going to condense this a little bit. So we have 8,000. Every one of those 8,000 is off by $8. So this will be the misstatement. So we're saying everything is misstated by 2. Now this 2, notice, is going to add 2, right? This is a positive 2. Somehow I really goofed this up. Okay. So it's going to add $2 for every item. So is that 16,000? And that is the projected misstatement. And again, this is an understatement. Why? Because we're saying that these are all understated by 2. So we have to add 2 onto each one of those. So the projected value would be so they're saying they have 380,000. We're saying it should be 16,000 higher. So what's that? 396, I think. Question on that thing. So the stiff test estimation is really a little unusual. That you generally take the misstatement first and then kind of back into the projected value. But now every one of these methods, though, whichever one of these you use, these are all substantive testing for dollar amounts. We don't care what the controls are. Well, we probably don't have a bad attitude or anything, but the controls have nothing to do with these. Maybe these weren't signed correctly or whatever. It doesn't make any difference. We're just looking at the dollar amounts to see if the financial statements are misstated. So substantive test is looking for the dollar amounts only. If someone didn't sign the purchase order or whatever, it doesn't matter for these. Okay, monetary unit, sample size. Do I have a friendly version of this here? I do not. I'm gonna copy both of these at once. Okay, so sample size. I know how to do it. Oh, not that. I guess I don't know how to do it. Okay. I could leave it centered like that. Okay, so total population, and again, population and dollar amount are exactly the same for this method. Why? Because each dollar is considered an item in the sample. So book value is 500,000. Times our reliability factor at 10%. Back down to the table. Liability factor at 10% is 2.31. I'm going to copy that. all of that is over our tolerable misstatement, which is 30,000. Not sure why I put that in the parentheses, but 30,000 minus our expected misstatement, 1,200, times our expansion factor. Expansion factor is down here on the table again. Oops. 10%, it's 1.5. Copy that. Okay. 100,000. Divided by 30,000 minus that. $1,200 times 1.5 is 1,800. So 30,000 minus 1,800 is 28,200. I'm going to finish it off here. Okay. Equals 40.95, so 41 rounded. So that's their sample size. And our interval
I'm getting 38.50 for the sample size.
Oh, did I do it wrong?
Yeah.
You got the other numbers, right? The same as I got? Or no? Did you get these numbers or no?
Different number at 38. No, I just did it all together.
I'm getting the same number. I get 40. I got 40.95, 40.96, something like that. Okay, one more thing. What'd you come up with?
It should be 41 where you have.
Yeah, I think it comes up to this. It kind of like 40.96 something.
It up later.
Okay. Yeah, so yeah, like I think like I rounded up to 41. Okay, so this would be the interval. So the total book value, which is 500,000. Be careful with this one because it's tempting to put that in there, which that really isn't the book value. The book value is the 500,000 we started with. So the book value is that, and the number of items in the sample is so 500,000 by 41, 12,000.
195.
Yep. 0.12. You just leave it this. This is that's enough. And by you don't have to put the sense in. If you think about it, at worst you'd pick an extra item. If it got up to be enough, you'd pick up an extra item. It certainly wouldn't hurt you. So this will be the interval. And just sometimes the beauty of this is lost on chunking out the numbers. The beauty of this is it tells you how many items to pick, and then it picks them for you. There's no random number table. There's no, and even though it took a little bit of time to do this, we didn't have to get a standard deviation like we would have to find a sample size for this. To find a sample size for this one, for these, is really a pain. And I don't think they've ever tested it on the CPA exam, at least not directly. They never said come out with a sample size for this, because you gotta get a standard deviation. You gotta jump through a bunch of hoops. It's really hard to get a sample size for these. I mean, I should say it's hard. It's just tedious to get it. Even though again it wasn't. I had to do a few things here, but much quicker to do this. And picks the sample for you. And two, if you do suspect that there might be fraud, that they're overstating, this is for overstatements. If they overstate it enough, it's 100% sure you're going to catch it. If they overstate it, if anything goes over 12,195, it's going to get caught. So in that way, it's a really, I can be a really effective method. Okay, this is the last one. I hope it is. We're out of time. All right. Here we go. Okay. What do we do with the first one here? I'll give you a hint. The first one's a wacky one. What is wacky about this one? This is something that this method is not supposed to catch.
Did the audit value is greater than the book value?
Yeah. This method looks only for overstatements. Now, by the way, this is also there's also substantive testing. We're looking for dollar amounts. But yeah, this thing is looking for overstatements. This is an understatement. Projected value is, there's nothing wrong with it. Which, to an auditor, incremental allowance, no, there's nothing wrong with it. When you come across an error, you go, oh, hey, look at that. Your audit years go up and you go, oh, look at that. I found something. And then okay, this is an understatement. We're not supposed to find it with this method. You just forget it. Okay, now this one is not. So we're going to divide, it's sort of like ratio estimation for the entire interval. We'll take audit, divide by book, times the interval. So the predicted value of this one is, I think it's 500. And the projected misstatement is 4,500. I think that's right. So this is like, this is what, 10% times 5,000 is 500. So we're saying this thing's misstated by 4,500. By the way, there's an unhappy coincidence that these two numbers are the same number. Would be including incremental allowance? Yes. Why? Because there could be more things that are wrong. There's only, there's only $200 worth of this interval. There could be more bad things in there. Okay, what's wacky about this one? That's the third one.
Book value is greater than the interval.
And by the way, this one is one that would be 100% sure that you're going to pick. If it's more than the interval, which it is, this one's going to get picked 100%. The misstatement, though, is we're going to ignore this here. The misstatement is going to be whatever the difference is between these two. Because we know for a fact that this one's off by $1,000. It's overstated by $1,000. And there's also not going to be anything else wrong with it. So this would actually be, I'm put underneath here. You would take the 5,500. So this one is actually misstated by 1,000. Now, the good news is, because it's such a large item, it could not get any worse. This doesn't really matter. This would be what, 4,000, I guess. Oops. Yeah. I may move this over a little bit. Okay, again, so this one, even though it's misstated, it covers the entire interval. There could not be anything else wrong in that interval. So we do not put it in our incremental allowance. It's as bad as it gets. So that will be that. And this will be, again, this is an unhappy coincidence. I gotta change this one. There's too many 4,500s and 5,500s that are not related. I apologize for that. As humans, we always try to make sense out of things. So when you see something that's the same number, you go, aha, that must be, and it's not. This 4,500 has nothing to do with that 4,500. This 5,500 is, well, is not really related to that one either. Who the heck made this stupid thing anyway? All right. Basic precision. Basic precision is just the interval. Well, let's go down and get it. How about basic precision? Oh, right there. I'll just copy it. Basic precision equals the interval times reliability factor. So the interval is 5,000. Times reliability factor. Reliability factor is at 10%. Go all the way down here for our reliability factor. 10% is that. $11,155. Scratch that. 11,550. And this is how much it might be off by just because it is a sample. And nothing to do with the errors. If you didn't have any errors at all, it could still be off. And that's what that one's telling us. Excuse me. So our projected misstatement, this is our best estimate of what it's off by. Our basic precision is 11,550. Incremental allowance, the one that makes us cry, or at least me. Now, how many incremental allowances do we need to calculate?
One.
One, right? This is the only one that we need to calculate for. So we just need to calculate one of these. So overstatement 1 minus overstatement 0 minus 1. Okay, so let's come down here. Overstatement 1, so 3.89 minus 2.31. So 3.89, I can remember that. Minus 2.31 minus, oh, too far, minus 1 equals, oops, equals some number. Okay, I'll get you more accurate. So 3.89 minus
0.58.
yes, 0.58. So we'll take 0.58 times the only one we have here. Now we take the largest one first. We only have one, so $2,610, I think. And so this is going to be our all these together are going to be our upper limit. We don't need these. Okay, so 2610 plus. $19,660. So that will be our upper limit. That's the most that, at 10%, that's the most that things could go wrong. For us. So the most, our best estimate is off by 5,500. Worst case scenario at 10% is off by 19,660. So this is actually the more important number because it's a sample. Do I give it? Oh, so the accounts receivable was 400,000. So we would say that this is overstated by whatever it is, 19,660. So the projected value would be, I don't think we did this before. Projected value, and then of course, this is the upper limit, be 400,000. Minus the overstatement of 19,660 equals 380, 340 maybe. So this would be our projected value of what we think at the upper limit, what we think that their financial statements would, for this account would be projected value of it, accounts receivable. So the misstatement, upper limit on the misstatement would be 19,660. Our projected value basically would be the minus the upper limit. So we say 308,000. Now, we should all get that same number. Whether this is material is a judgment call, right? I mean, so one auditor might say that that's material, one auditor might say that's not material. But the number itself is not disputable. Any question on that? Okay, well, I took you guys way too, 10 minutes over. That's not so bad. I think we're supposed to go to 8:30, but that's a little too long. Okay, well, I will be sending out this exam and it will be due on the 29th. Let me. Oh, I already put that in there. See that? Okay, so I'll send out the sampling exam and it'll be due on the 29th. And again, I also belatedly put out the chapter 10 and 11 exam for the to submit it. And yeah.
And that's only 6 questions, correct?
On the exam?
Yeah, the one is due on Friday.
I can't remember.
Well, yeah.
Here already. You did. Look at that. Yeah, and this was the hard one. 6.
Yep.
This comes right off of that's a CPA one. That's one that appeared in the CPA. Yeah, 6 questions. So I'll send out the sampling exam tonight. I'll go out tonight, and I'll be sure to go ahead and put it in Blackboard.
Which one is the sampling exam? Is it the one that we just did?
Huh?
Yeah. Well, I didn't put it the chapter 10 and 11 exam. I didn't have it in the submit thing.
Okay.
I put it in now. Well, I put it in before class, just right before class. I put it in. So that one you can submit, the 10, 11. I apologize for not putting that up. I thought I had. And so I was going through checking in the homework and stuff. I was like, how come no one turned in the test? And I realized I didn't put it in. Anyway, so I will put the statistics exam, and that'll be due, let's say, on the 29th. So next week, Friday. A lot of stuff tonight. It's good stuff though. That the ethics stuff is on the CPA exam, and this stuff is good. This is how you determine whether their financial statements from the state or not. So anyway, any questions? I apologize for I tried to get you guys out of here by 8, but I failed today. So anyway, I will send out the sampling exam probably within the next hour.
Which one is the sampling exams? Is it the one that we just did?
No, the one you just did is the 10 and 11. 10 or 10
Yeah.
and 11. The sampling exam, I think technically in the book is on problems or on chapter 7 and 6 and 7, I think.
Oh, okay. So
Yeah,
you're gonna send it to us.
Yeah, the reason I don't call it chapter 6 and 7 because the way that they're showing it in the book is, I have no doubt that it's effective, and it's what probably whoever wrote the book did when they were in auditing. That's usually not the way they show it on the CPA exam, though. So the way I show it is kind of the way on the CPA exam. Absolutely nothing theoretically wrong with what's in the book, but just to avoid confusion, I don't really rely on it that much. So anyway, yeah, so it's not the sampling exam within the next hour or so, not due until Friday of next week.
Okay.
Questions? Okay, well, have a good week, and I will talk to you in a week's time. All right, good night. What am I doing here?